Charles. Always great to have you on days like this. Good to see you. In his comments, at least his prepared testimony, he does say that the implications of Ukraine are uncertain. I wonder how far you think he takes that. Does he frame it in a way that suggests that you got to assess those implications before you start talking more about stimulus exit?
Well, maybe. I mean, I think he's trying to play the middle ground and not trying to seek it to accelerate the market's expectations, but also not ruling out the possibility that things may turn out differently than they expect. I mean, after all, the Fed has spent the last year dithering around about inflation, blaming it on one thing or another, blaming it on everything except their own policies. So now they waited and waited and waited. They finally made a move to recognize they have to tighten, and the markets recognize that as well, and they priced in all these rate hikes. Remember, in September of last year, the Fed only expected 0 or no rate hikes in 2022. Now they're up to 5 or 6. This reminds me of the old stop-go policies or go-stop policies the Fed followed in the 50s and 60s and 70s. And sort of return to those old practices. They dithered so long that now they're facing the prospects of more rapid rate increases, and the market's recognizing that. And it's going to be exacerbated by, I think as was mentioned a few moments ago, rising prices of commodities, oil, and other things are going to aggravate inflation, not help bring it down in the near term. And so they don't want to be seen easing or not raising rates in the face of more inflation. So they're in a real box, and they've kind of made this box for themselves.
Right. It's interesting to hear you make comparisons to the 70s, because Bullard, who of course has no problem throwing tape bombs around, this morning, according to some of the comments that the Journal is citing, says this does remind him of the 70s, even though some have argued that the picture is much different. What do you think?
It does remind me of the 60s and 70s. The Fed in the 70s eased appreciably or didn't tighten in the face of oil shocks, if you will. And they just increased the risk or fed into the notion by not doing that, fed into the notion that, these oil price shocks were translated from temporary shocks into more permanent ones because the Fed didn't tighten and address them. So I think it's a very, very similar situation. It's eerily similar for those of us who lived through that era.